Hi, this is jeng with Full Capital, and today we're going to be talking about forbearance. And the question really is to forbear or not to forbear. Let me just jump in. A little bit of my background. I was a loan underwriter for G Capital for 8 years on the commercial property side. And then the last 5 years have been really focused on multifamily debt, originating close to $750 million across 125 properties, and then also investing in about 25 properties across DFW, Austin, and San Antonio. And so today I wanted to talk about forbearance, and there's been a lot of information that have come out about forbearance, but I wanted to put together, this came out of one of the desk lenders we work with, CBRE. They put together a chart comparing Fannie and Freddie. So some of the things that are similar, both of them are offering 90 days. They're offering you 12 months to pay it back. They're not charging you any interest during those 12 months. Both of them are going to want to see some sort of hardship that is needed on the property. They're not just going to let you do it for free. You're going to have to write them a letter, show them the reports, rent rolls, financial statements, collections, delinquency, explaining sort of why there's been a drop in collections per this COVID-19. This is where one of the differences came in. The restrictions on tenant evictions. So Fannie Mae, while you're in forbearance, for both Fannie and Freddie, you can't evict anybody. But Fannie Mae, you have 12 months to pay it back, and that entire time you do not keep the loan current, you can't evict anybody. And so that is a challenge, I would say, for most properties if you can't evict somebody for non-payment. Right now, the understanding is that Freddie Mac, it's really just during that 90-day forbearance. So that's one difference. And then also Fannie Mae, let's say you take the forbearance, you can't, you have to give tenants 12 months to make up these payments as well. And so if you do take that forbearance, not only can you not evict, but then your ability to bring all those payments current with your tenants, you have to give close to a year. Both of the agreements essentially are going to be similar to your loan documents. They're going to send you the agreement and you have to sign it if you want to do it. Freddie, it looks like there's not going to be much of a cost to it, but I think Fannie, I saw, was about $750 to do the agreement, to sign off on it. Decisions in terms of timing, this came out of CBRE, so it's going to be the dust lender on the Fannie Mae side, and then potentially the master servicer, which is typically similar to a dust lender on the Freddie Mac side. I'm trying to see if there's anything else here on this side, but I mean, the main, the one other thing that was highlighted here is that there will be no distributions during forbearance. So to your investors, to anybody, they really want it just focused. If you're in forbearance, all the money is going towards the property. So normal operating expenses, turning units, things like that. So no partner distributions and no big renovations during forbearance. And so I made this chart. I was trying to figure out all right, what's the pros and cons of doing forbearance? So obviously a positive is, you can increase your cash reserves in the short terms because you can't make the mortgage payment, and avoiding foreclosure versus just not paying, right? So that's positive. However, the negatives, obviously you have to evict tenants. You can't evict tenants during forbearance, during Freddie, and then you have to pay the money back. And then until you pay the money back, you can't evict anybody on the Fannie side. And then you got to work with the tenants for 12 months, and you got to pay back this money within 12 months. So a lot of people thought, all right, I'll forbear now, and then I'll pay it off or pay these payments back, when I refi 3-5 years from now, or sell the deal. But no, they want the money back within 12 months, and then no distribution to investors. And so right now, there's a lot of negatives until maybe they change up the program, but we'll just have to see. I mean, they want you to keep making these payments. So what I wanted to do is sort of figure out, all right, to forbear or not to forbear, right? So the things that I made a little spreadsheet here. monthly income, monthly expenses, your P&I payment, what's your cash on the balance sheet, and then what do you think your income and expenses are going to be for the next 3 months, and then maybe even forecast for the entire year. So I made some assumptions here on this deal. I took a 200 unit deal here in DFW. I assumed 3 months of income drop, and then I brought it back over the next 4 months so that essentially March mirrored, let's say, November of the end of the year. So it's about 7 months or so. And then expenses I kept. I think people are going to scale back expenses, whether that's repairs and maintenance, whether it's payroll, G&A, those advertising, those items that are controllable, they're going to scale it back. So I just did 10% expense reduction. And so I wanted to show this one as an example, sort of case study. So monthly income was 191,000 on this property. Monthly expenses were about 85,000, and then that included taxes and insurance. And then the P&I payment was 72,000. And so if you look at the right-hand side, depending on the income drop, so that was the variable, the income drop on the top side, and then versus your starting loan or starting cash balance, that determined whether or not you would need to forbear. And the breaking point was, at any point, did you essentially just run out of cash, right? And so let's take, for example, let's see if I can highlight here. So $160,000 was your starting cash balance today. And then if you had a 50% income drop, then you essentially needed to forbear because you were going to run out of money, right? But then at 180, you were right on the edge and you would be okay. And so I ran this just based off of a 200 unit deal. Let me see if I can pop over to the Excel here. So this is the Excel that I created, and essentially let's plug in 160,000 and a 50% income drop. And you can see here, right after April, May, June, you're burning essentially 53,000 a month. And so you just can't catch up, right? And so you can, in July and August, you're out of money, right? So that 160,000 is a yes on the forbearance side. But look, if you had $180,000, you come out positive. I mean, it's not much, right? It is positive, but it still makes it through. And so you can sort of plug in your numbers here. I'll make this sheet available. Plug in your income, expenses, P&I payment, how much you have on the balance sheet, and what your forecasted income growth is. And then, so let's say it goes to 60% income drop, which is pretty dramatic. You need close to 260,000 just to make up to stay in the game here and not get too far behind and not be able to miss your payment. And so let's see. So that spreadsheet I'll make available to you guys. But that I thought everybody right now, sort of before April 1st hits, the first couple of weeks of April, we're going to see the battle for collections here. I would sort of run that analysis, make some projections on what your income's going to be, what expenses you can cut, sort of what's your P&I payment, and how long you can survive through this. And if you like this channel, subscribe to the YouTube channel, like this video. And if you want to set up some time to talk with me, complete your personal financial statement, send me an email at jeng@oldcapitallending.com or give me a call on my phone. Thanks a lot.